Thank you. So, hello, everybody. Hello, Harumi and Dale. It's really great to see you and to meet you. Harumi, you and I know each other a little bit, and Dale, you and I have never met yet. I'm going to. I've set it up so that each of you has permission to speak. So, because we're a small group, if there's questions that you have, we'll be able to have your questions verbally. If you also like, you can use the Q&A function. So you'll see at the bottom of your screen, there's a Q&A. And if you want to type out a question that you want me to get to at some point, I will be happy to do those. You could also use the chat function if you want as well. And I'm by myself, so I'll try to monitor this as we're speaking, and we'll handle it that way. Just so you know, this is being recorded so that it'll be available. There's one other participant who is either going to join us late or cannot come this morning and today. And so we're going to be recording this, and Cast records all of these. So just so you're aware that this is being recorded. It's not going to be sent publicly, but it's going to be made available to another participant. So if that's okay, just so you know, I'm going to begin by telling you what we're going to do today. So we're on till at the 11 o'clock local time in Pacific time zone. And so Harumi, that will be 1 o'clock your time, I presume. That's when we'll stop. We'll have a hard stop then to keep our commitment to you about the time slot. The format will be that I will be speaking about the topic, and I'll try to pause every so often to see if there are any questions or any discussion points that you want to cover. And in the meantime, we're going to proceed then with the introduction. So my name is Henry Katarna. I am a CAST EIR, an entrepreneur in residence at CAST. I actually live in Calgary and Vancouver. I go back and forth between the two cities. And I am an investor. I run an investment fund for my family. So I have one brother and three sisters, Toronto, Regina, Calgary. And I am the oldest of the five kids in our family. And we've been working together for a number of years, mostly real estate investments. But in the last 10 years, we have done some technology investments. So we are in 22 technology deals. We're angel investors, and I still see 150 to 200 deals a year. And so the course that we're talking about today, Are You Investment Ready, is based on the perspective that I'll bring you today is that I am an investor. I see a lot of deals. I know a lot about angel financing of deals, have done, like I say, 22 of them ourselves. And so I'm hoping to be able to help you today to understand the investment readiness process. This whole workshop is 6 hours in total, so we'll have 3 days with 2 hours each. And I will be happy to do this with you. If you want to email me in between sessions, I'm perfectly happy to answer your questions or phone me. So my email address is h2@katarnacapitalcorporation.com and h2@katarnacapitalcorporation.com. If you want to email me at any time, happy to receive your email. And if you want to phone me, my phone number is 403-630-1781. And happy to talk to you. So again, 403-630-1781. I'm going to, first of all, tell you what the purpose of this workshop called Are You Investment Ready is. And then I'm going to ask for a minute or two of introduction from each of you, just so we know your experience and who you are and your background for this kind of a course. So first of all, the Are You Investment Ready? It's intended to learn the basics of the investment process. I'm going to make sure that you are fully aware of the different kinds of company structures that attract investment. I'm going to speak with you about how to communicate effectively with investors so that you're always talking with them and you're always presenting them the facts about where you are with your deal. I'm going to speak with you about how to identify the amount of capital that you need, the types of capital. There's a lot of different ways to bring capital into your company, debt, equity, and so on. And there's a lot of different instruments. So we're going to talk about that. This would be a non-technical. So, you could take a few notes, but it's going to be just informative for you. I'm going to talk about how to target and curate investors. There's a lot of investors out there, lots of different types of investors. You could waste a lot of time talking to the wrong investors. So I'm going to provide you some insights into how you target the right one and how you curate them so that you get the right people to talk to. We're going to talk about deal structure. There's lots of ways to do deal structures, and there's some pitfalls, and there's some how-tos, and there's some lessons learned. So I hope to pass on some of those valuable lessons to you. We're going to talk about the time frame, how the time frame of investment works, how the decision-making process works, and just generally what you should expect in the whole process. How to position your deal will be another topic that we'll talk about. There's different good ways to do that. How to calculate and defend your valuation. This is a big deal. Valuation is such a complex topic, but there's about 5 different ways to calculate valuation in your business. And I'm going to leave you at the end of this entire 6 hours, I'm going to leave you with actual tools of how to defend your valuation, because valuation is a negotiation, and to win the right valuation number for your business, there's ways to do that properly. I want to help you avoid the common mistakes when you go out to seek capital, and I want you to not underestimate the nature of the challenge in front of you. And I would like to leave you with an understanding of what goes on in the mind of the investor, because the investor sees a lot of deals, they see a lot of information, and they think a certain way. And so I want to be able to leave you the techniques and the tools of understanding what goes on in the mind of the investor. All of what I've just said is what we're going to cover in 6 hours. And this is really part 1. This How Are You Investment Ready is part 1. Part 2, it's another webinar that is actually booked in cast for April 1st and on. So that one is how to prepare the right high quality pitch deck. So a slide deck of a 10-minute, 12-key question pitch that actually teaches you how to do it. At the end of that workshop, which I think that's 10 hours in total, you will end up with a pitch deck that actually is a high quality pitch deck. I'll work with you. There'll be homework in between sessions. And the point of that is to work back and forth and create a valuable, sharp, high quality pitch deck that will work to get you the next meeting. Pitch deck doesn't necessarily get you a check, it gets you the next meeting. And so we're going to have fun with that one. If you are going to be interested in signing up for that one I believe starts on April the 1st. So anyway, that's a little bit of an introduction. It's a little bit about me. I wanted to just pause for a second there and see if either of you have any questions about that. And in a second, we're gonna make introductions here. But first of all, any questions from Dale or Harumi on what I've just said?
I guess the only question I have is there going to be any sort of homework or anything of this nature during the first session here of 6 hours?
Not any homework that I'm going to assign you. In the pitch deck part, yes, there will be, but not on this one. You'll be able to just take this thing, each module, and with your notes. And then if you want to have for homework, if you would like to contact me on any particular problem or specific issue in your company, I'm happy to do it, Dale, but no specific assignments that I'm going to give you between sessions.
Okay, thank you.
Okay. All right. Could we then, Harumi, any question from you? Okay, great. So how about this? Could we ask for an introduction? I'll start, Dale, I'll start with you, and then Harumi second. Could you give us a minute or two who you are, what's your company, what you make and manufacture, who buys it, what's your product? Also, what is your experience with capital? Have you raised capital in the past? Are you intending to raise capital? And sort of the state of your business. A couple of minutes each would be very helpful. Dale, could we start with you, please?
Yeah, absolutely. So my name is Dale McCaroff. I'm the founder and managing director of MKV International Trading. I established this company in 2012 in Vancouver. We're a shipping container wholesale and trading company. We import, sell, and rent steel shipping containers primarily in British Columbia. I have a small yard in the Kootenays as well, Castlegar, that is. And I started this business, like I said, in 2012, buying one shipping container, flipping that for a nominal profit. And I kind of built my way up from there. And now for the past couple of years, our sales revenue has been about 1.5 million. I'm a sole proprietorship. I work with my sister. I taught my sister sales, so she primarily does a lot of the sales of the company. And I'm in the midst of incorporating the business here, hopefully for April 1st. I haven't raised any capital of that nature, just bank line of credits, stuff like that.
Right. Yeah. Great. Thank you, Dale. Well, welcome to the session. Harumi, please, could you give us a quick background on yourself and your business?
Sure. Yep. Um, I manage finance for a company called Retreat Guru. We are a technology company based in Nelson. We supply reservation booking software specifically for the retreat segment. We sell our software globally. And we also have a marketplace. If you go to retreat.guru, you can find a dream wellness retreat target towards really authentic awakening experience. I've been with the company for about 2.5 years. We raised a C round of capital right before I joined, and we were thinking about raising Series A. It would be this year actually, but with the COVID, our client base is basically retreat centers, hugely dependent on travel and in-person experience. Although there's a new online market that's growing very fast, but we have taken a big hit to our revenue, and we don't currently have any plans to raise at the moment. We are very mission driven, so we like to maintain our control, and that's always been a key for us in devising any capital raise strategy. But I wanted to join this webinar knowing that we might not be raising anytime soon, just to have the experience or the perspective of what investors might be looking for and how to prepare in case we are ready.
That's great. Well, thank you, Harumi. That's good background. So do either of you have any questions for the other or for me before we start about our backgrounds or what we bring to this particular workshop? Is there anything else?
No questions at this time.
Okay, great. Well, thank you very much then for giving us that background. I'm going to run this workshop on the basis of, I'm going to proceed with my comments, and then anytime you have a question, please feel free to either break in with your voice, audio, or you can do a Q&A or a chat with me, and we can make sure we address your questions. We'll take a break at the halfway point, so kind of probably at the top of this hour at 10 o'clock or 10:15, we'll take a few minutes break just so that we can regroup and attend to whatever is necessary, a refreshment break, whatever, and then we'll come back. Okay, so I'm going to start then, and I'm going to give you, today we're going to do segment 1 and segment 2. If you're looking at my little email handout, we're going to talk about segment 1, which I call preparation essentials. And then segment 2 is in the second hour, the matching of your business life cycle with the types of capital. So there's some complexities there. To begin with, in the first segment, preparation essentials, I'll begin by saying that the basic format of your pitch deck, and we're not going to talk about the pitch deck in detail today, as you know, but I just want you to be aware that the basic format of a pitch deck, it's the standard way that investors receive your initial information. So they will not, again, I presume you might know this, but they won't be interested in a phone call or you sending them a 50-page business plan or a marketing plan or anything like that. Now, they might have preliminary telephone call with you or a Zoom chat or something like that. But the purpose of the pitch deck is to make the case and make the story familiar to the investor about what your situation is. So the beauty of the pitch deck, and usually the pitches these days are anywhere from 6 to 10 minutes. So I'm working on the basis of a 10-minute pitch with about 12 key questions that have to be answered. You may go to some different forums where you get 6 minutes, and that's a very brief time, and it's very difficult, and you can't just talk faster, you know, to get your point across. You have to really clarify your message. So the purpose of the pitch deck is to unfold the questions that the investor has about your deal in the way that their mind thinks. And so there are 12 key questions, and they go in a sequence. And their sequence is that they start with, you know, who am I, what do I make, and who buys it, and that sort of thing. And it goes all the way down to what business problem you're solving, what your solution is, what your technology is, what your go-to-market strategy is, what your revenue forecast is, what the technology is that you're using, what is your team, who's on your team, what kind of milestones have you achieved, and then kind of it ends with the ask. What are you asking for? Money, money and advice, or people to sit on your board, or anything like that. So my first point to you is that the basic format of the pitch deck is to tell your story in 12 slides in 10 minutes. And that's the magic of that, is that there's about 12 boxes that are in the head of the investor. And this is fairly well known. I can't prove it to you by any kind of a survey, but I know that this format that I've developed, the 12 key questions, has been in use across Canada in a lot of angel investor groups. And it's very commonly known in the US as well as a way to listen to 12 points that get the message across. And if they're done in the right sequence, it allows the investor then to focus on your next question. If you get these out of sequence, what we have found is that it creates a little confusion, and the investor starts not daydreaming, but thinking about things in a way that is, you know, gets you off track. So if you follow the 12 key question format in the right sequence, you check off the boxes in the mind of the investor in a logical, orderly way. The second thing about the pitch deck is that it's complete. If you answer these 12 questions, they are the most typical questions that the investor wants to hear about in any kind of pitch. And if they're like me, they will see, you know, 50, 100, 200 pitches a year, or many more. Some angel investor funds or groups, or some VCs will actually, you know, listen to hundreds and hundreds of pitches a year, and they need a way to scrub through them, curate them, and kind of make decisions. What's the point of a pitch deck? It's to get the next meeting. I mentioned that earlier. We don't expect to get a check, although I have seen it. I ran an angel investor group for 12 years at Innovate Calgary. It was called Invest Tech. And we would see 300 deals a year, and we would pitch about 25 of them a year to our group. We had about 150 investors, and they met every month. And one time, a guy came with a pitch deck that was for portable housing, like for emergency shelters in third world countries in case of a disaster, kind of an igloo style structure. And this guy, his entire pitch consisted of a couple of words from him at the beginning and at the end, but it was really this igloo thing and it was a sort of a slow motion or stop action video, 6 minutes worth of people assembling these little housing units rapidly. And people wrote checks that day, right after the pitch. They were clamoring to run up to see him. So I wish you all, in case you're raising capital someday, you know, the excitement of actually getting checks kind of waved in your face right at your pitch is very amazing. But it never happens, except, you know, in that one story. And so you are expecting to then get the next meeting. The one other thing I'll say about this getting the next meeting aspect of it is that when you book the next meeting, that's when you produce your 150 slide deck. And that means that you've got all kinds of detail, like in a decision tree type of format, on every point you've made in your 12 key questions. And the next meeting is when the due diligence begins. That's usually when you produce an NDA, a non-disclosure agreement. No investor will sign an NDA to hear your pitch. So just saying, if you are contemplating going in front of angel investor groups or VCs or anybody, when you do your initial pitch of 10 minutes, 12 slides, whatever, you're not going to get them to sign an NDA. And so therefore, a point I'd like to mention is that you should protect your IP by making information available in your pitch that's not proprietary. And it can be done. And, you know, like I say, if you go through the 12 key question format pitch deck thing starting April 1st, I can show you how to do this without putting yourself in danger or risking your intellectual property or risking, you know, financial details that are proprietary and that put you at risk. So this is I'm on the first bullet point. It's kind of, this is why we follow a format of logically ordering your information. And it's why we want to make sure that the 12 points are complete, because that's how the mind of the investor works. And once again, the purpose of this pitch deck is to get the next meeting. It's not necessarily to get a check, it's to get the next meeting. So I'm going to move then to the next point, which is the story you want to tell, but I'll just pause there. Any questions on that one?
No, no questions. Sorry, I'm just looking at the slide here, Henry. Is that, are you on number 2 there?
I'm on the slide that says segment 1, prep essentials.
Got it. Okay.
Yeah, thank you. There was a, yes, I see that my slide guy has put in a quote from Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So great lesson. But yes, I'm on that slide called segment 1.
Okay. Yeah.
And so the next point in that is the story you want to tell. And, you know, if you study literature, you know, there's an arc to a story. There's a kind of a beginning and a climax, and then a denouement, or kind of a conclusion to the story. And in the course of telling your pitch and making your company investment ready, you want to tell the client, the possible investor, that your company is either a startup or an early stage or a growth company, that you have a real business problem you're solving, and that you're proceeding along on with dispatch, as they say. You're moving along at a fair pace, and you're going to conclude with they're going to put their money into your deal, and you're going to turn that money into some kind of a return on investment. And so the story that you would be wanting to tell when you're investment ready, this is the key point here. When you are going out to seek capital, no longer can you be a lifestyle business. And, you know, I'm sure you might have heard that term. What we call a lifestyle business is that which, you know, you work at your pace. You don't accelerate. You don't rush to market with new products. It's not that it's casual, but you work at a pace that's organic, and you don't, you know, you control the pace yourself. You decide when you want to go to new markets. You decide when you want to add new products or new features to your products, that sort of thing. But what we want to get across to people is that if you're running what we call a lifestyle business, investors will not be interested in you I mean, you might find a friend or a relative or somebody that's very close to you that trusts in your approach and shares your approach, in which case they will then join you. But once you accept a dollar of somebody else's money, particularly angel investors or venture capitalists who are in a certain way professional investors, you are on a path to exit. So always remember that when you accept somebody else's money, they will expect you to be on a path to exit. What does it mean as an example? Well, as an example, it means that you, let's take an example of me as an angel investor. If I put money into your deal, I expect 5 to 10 times my money back in 3 to 5 years. 5 to 10 times my money back in 3 to 5 years. And why do I expect that? Well, it's because I might put money into 10 deals, let's say. Of those 10 deals, 7 will fail, probably. 1 or 2 will muddle along, and maybe 1 is a home run. And so if I put, let's make up a number, if I put $100,000 into 10 deals each, that's $1 million. If 7 of them fail, well, that's 700,000 lost. If 1 or 2 of them muddle along, well, maybe I get my money back, or maybe it takes 5 years to lose it, or it dribbles it away. But the one that's a home run, I need to have $2, $3, $4 million out of that one in order to make up for the $900,000 I've lost with the other ones. Because you'll remember that when you go out to capital for angel financing or venture capital, that's very early stage money. That's before banks will come in. And I know, Dale, you have had experience with lines of credit, and Harumi, probably you as well. So the point is that you have this this expectation that an angel investor wants 5 to 10 times their money back in 3 to 5 years. So they want it quickly. They want a lot of money back because they're taking a lot of losses elsewhere and they need to recover it from your successful deal. So they're going to look at you from that lens and that perspective. And it means it puts pressure on you. You can no longer be a lifestyle business that goes at your pace. Once they put money in, any kind of outside money, it's their pace that sets the tone. Even if they don't control your board or control voting shares, they're going to put conditions on their money when it comes in. We'll talk about this later on during these 6 hours. And they will put conditions on that money so that you move fast. You have to pick up your pace. You have to then grow into new markets, add new products, do new features, do things to accelerate the game. And so, but it's the good news is that you're perhaps going to be diluted. You're going to do it quicker, and you're going to have then a smaller share of a bigger pie. And the faster you can do that, the more you can be ahead of your competitors too, then the better off you will be. So this is I'm still on the second bullet point. The story that you want to tell, the sort of the literary arc of the story, is to show them without overselling it. There's no place for hype in a pitch, even though it's kind of a hype thing, because you're trying to convince the investor that you have a good deal and that your business plan is an exciting one and that it's going to get the results that they need. And if they're going to put their X dollars into it, 100,000, 500,000, whatever number, if they're going to put their dollars in, you're going to multiply those dollars in a fairly rapid period of time, and you're going to make them money. So that's the kind of that's the story that you want to tell. The other story that you want to tell, I'll introduce here the concept of realism. You have to be realistic. There are risks to every deal, and investors see a lot of proposals. And so they might have sitting in a room, if let's say you're meeting a group of investors, you could be sitting in the room with a number of investors, and some of them might know your type of business. They might have experience with that. And so they will be looking for how you are going to distinguish yourself from your competitors, and how you're going to be better than all of them. And so they're going to be looking for something like that. Another part of the story is you, the leader of the business. I'll tell you that there was a study done by the Kauffman Foundation. You can Google this sometime. The Kauffman Foundation is a famous American institution that does a lot of work on investment in general. The Kauffman Foundation did this study, and it showed that the contribution to value in a company is not, as you might think, the product or the business plan or your potential market, even if it's big and growing. That's not what they're interested in. What really counts is the team. So the highest contribution, the highest contributory factor to a high valuation is the team, not the business plan. Because why? Because the business plan, which you produce today or next week or next month, will be invalidated in a short period of time because of the world situation. Look what happened in the last year. In February, did you expect that we would have a world scale pandemic with all of what's happened? Probably not. If you did, well, good for you, but most did not. And so we were all taken by surprise, and it had a dramatic impact. What's the test then? The test is, how did the people leading these businesses survive that? What did they do to pivot? What did they do to make a rapid change? And so what we discovered is what the Kauffman Foundation has been saying for decades now, which is that the highest contribution to value is actually the team. And so part of the story that you want to tell is that you have this beautiful team that has come together. And even in the case, Dale, for example, you're a one-person show, you're teaching your sister the business, that's great. But still, the investor will look at you. And Harumi, it's the same thing with you and your team. The investor will look at you all and say, are these people resilient? Can they handle a crisis? What happens when the world changes on them? What happens when the business plan that they produced for us that we bought into is thrown out the window because it's no longer valid? That's the test of you as a team. And that's the thing that, despite the fact that you're answering 12 key questions in the right sequence, blah, 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 right? All that stuff we said a minute ago, they're going to still look at you, the leader, or you, the team, and they're going to say, can that group actually do this for us? So that's the, again, on the story, there's a powerful story to be told, not so much hype, but factual. And when there are challenges, or when you don't have the full solution, or you're lacking something in your team, it's best to be honest and to state it. This is a hard issue for many startups and early stage companies. They don't want to talk about the negatives or the realities. They don't want to talk about the pitfalls and the challenges. But the smart investor will have seen this kind of story, even if they don't know your industry or your particular product very well. They will have seen a lot about, how things work out or how people gloss over problems. So I urge you, when you're doing to become investment ready, it's really, I'll give you you've done SWOT analyses, I'm sure, strengths, weaknesses, opportunities, threats. I do a plus delta. A plus delta, plus is the positives, the things that are good that we would retain in our business, the things that will make us successful. The delta is like the mathematical symbol for change, delta, the Greek letter delta. That means that which should be changed or modified or discarded or thrown away or tossed out and started over again. If you do a plus delta on your product, on your technology, on your market analysis, on your capital structure, your distribution plan, all that sort of thing, and on your team, if you do a plus delta, I'll throw that in right now as a tool. I urge you to do a plus delta on a continuing basis, not just once, but on a regular basis, whether that's monthly or at different stages of capital or different phases when you are working on your storyline, you would want to be doing plus deltas all the while, because the investor will be as well. They will be trying to learn about your business. They will be trying to understand you, and they will dig out pretty quickly. It's amazing. I can tell you my own story. When I look at a deal, I can pretty quickly tell you what the strengths and weaknesses or what the plus delta is on a company after only perhaps an hour or half an hour of discussion. It's an interesting thing. Some of it is gut feel. Some of it is, subjective. It's not necessarily provable, but most investors, when they have a lot of experience looking at deals, are going to be right about that. And so it's not that you would lead with it and kind of, put out all your negatives or all your weaknesses up front, but at some point in your presentation and in your due diligence discussions, you would want to be factual about that. Okay, so that's a little bit about the story that you want to tell. I'm going to keep moving here. And I know that if you have questions now, I won't necessarily ask each time, but if you have questions, I know you're going to stop me and you're going to ask those questions. So thank you for doing that. Let's move to the next, the mechanisms and instruments. This is a bit of technical. So the typical mechanisms for growing your business, if you've decided that you want to take somebody else's money and you've decided you want to become investment ready, well, what are the mechanisms and what are the financial instruments that are out there that people use? So I'll do a little bit of a survey for you, just in general. One is that, let's talk about the mechanisms. I would say that there are two main mechanisms for putting capital into your company to help you grow. And one of them is going to be debt, and the other will be equity. And debt, as you know, this will sound obvious to you, it's borrowing people's money. And so there are investors who will lend you money. We're not talking about banks here because we're talking about earlier stage companies. And so there are investors, there are angel investors, there are funds, there are super angels, and so on, which we'll get to in about the fifth hour of this 6-hour workshop. There are a lot of different people who usually use these two mechanisms, but the debt one can take the place of somebody will lend you money at a particular rate of interest. Somebody might create a line of credit type of thing, a revolving fund that you draw down when you need it, according to different milestones. And so on the debt side of things, there's a whole range of them. I'm going to talk to you in a second about what the instruments, what are some examples of instruments there. But let's switch over to the other main kind of mechanism, the equity one. That's where somebody will buy shares in your business. They will actually buy shares, and then they will share in the risk of that business alongside of you, whether they have the same class of shares as you or a different class of shares, but they're going to share the growth, the pains and the sufferings and the wonderful things and the positive things that happen, all the way to the end where presumably, because you've accepted their money, you're going to exit the business. Someone's going to buy you, or you're going to sell it to your employees, or you're going to somehow be taken out and you're all going to make a lot of money and live happily ever after, that type of thing, or use the money to do good in the world and that sort of thing. So debt and equity are your two major mechanisms for financing a business. Now, we do have founder capital. The affectionate joke among angel investors is the triple F's: friends, families, and fools. Friends, family, and fools are the investors. That's nothing about any individual company, but there's a humorous kind of a connotation to that, because sometimes we will have financed our startups from family money, our own money. We'll mortgage our house, we'll take our savings account and empty it and then put it into our business. And perhaps you've done that, or you know people who have done that. But that's founder money, and that's not necessarily, I don't want to insult anyone, but it's not rational sometimes. Sometimes it's very rational, but sometimes it's not. It's because of loyalty to you or to me as founders of a business. Our family, our friends, our close associates might spot us a bit of money just because they think we're great people and that they believe in us and in our cause and so on. But beyond that, once we start accepting other people's money, the two main mechanisms would be debt and equity. Now, some examples of financial instruments. So let's take the debt side. On the debt side, you will have, like I say, people could lend you money. They could say, here's $100,000 and you pay me back over, I'm making this up now as an example, 5 years. And you're going to pay me, because it's a higher risk, you're going to pay me 10% interest. And they then lend you that money and off you go. You use that money to build product or to develop a sales and marketing machine to push your product into the marketplace. And then you will have to be earning income, making margin, and then paying it back, as well as paying the interest back. And depending on what the terms are of such a deal, you could be, successful if you believe in your sales forecast and your sales projections grow rapidly, and then you're able to cover that. If you're not able to cover that, well, then usually in those kind of deals, you've got some kind of provision where if you go into default, just like in a bank, if you default on that commitment, you're going to then suffer the consequences of whatever that is, whatever is laid out in the agreement. There's another kind of an instrument called a debenture, and the typical one in angel space is the convertible debenture. And so this is it's debt. You're borrowing people's money. So I'm in a couple of deals where we have debentures, and so we've lent the company money and at a particular rate of interest. But there might be a provision in there that the interest is not payable until later on, until you've got, a certain milestone has occurred, like a certain level of sales, a certain volume of sales, or a certain valuation of the company, or even time. It could be, interest accumulates and then in 5 years it's payable. So the convertible debenture is an interesting mechanism. And then there's something called a SAFE, S-A-F-E, capital S-A-F-E. You could Google that one too. It's a simple agreement for future equity. And so people will lend you money under a SAFE agreement, and it means that you're going to pay them back later on according to some mechanism or some proof of something happening, and then you'll convert that to equity. And the same thing occurs, just jumping back a moment to the convertible debenture. The whole point of sometimes that interest accumulating for 5 years and never having to be paid is then, if the company is successful and the value of the shares has increased, sometimes a convertible debenture will convert to shares. That's the point of a convertible debenture. It'll convert to shares. And so you don't end up paying any money back, but you now have fellow shareholders. And so you've diluted yourself a little bit. So again, the purpose of today and this 6 hours is not for you to become experts in these mechanisms, but these are typical. You're going to see this kind of talk if you go out for capital, straight debt, straight lending, convertible debentures, safes, and other such mechanisms on the borrowing side. There's a friend of mine in Calgary who, he's a very old guy. He's in his 80s now, and actually he's quit doing this, but he's a billionaire, actually. He's an oil patch guy who made a couple of $1 billion. And he used to run this line of credit thing. So he would look at your company, he would look at your pitch deck, he would conduct all kinds of due diligence. And if he believed in your company, he would not take a board position or he wouldn't take a kind of a governing role, but he would have observer status on your board. Or if you're a one-person show, he would just look over your shoulder and he would be aware of all the things that you're aware of: financial statements every month, market research, sales forecast, all that stuff that you do as business people. He would be familiar with it. And then he would have this line of credit thing where he would dole out money to you on a as needed basis, just like a bank would, just like your line of credit. He would do that, and he was like a one-man line of credit. But he was very popular because he was an angel investor as well. So he wasn't, cutthroat and ruthless like the banks are. He was actually an angel investor. And by the way, that's why the term angel investor came about, because they kind of fly down from, from the celestial sphere, and they help you. They're angelic in their behavior because they actually believe in the high risk early stage company. They love the entrepreneurial spirit. They're supporters of it, and maybe they've come there from that themselves. So again, on the debt side, these are simple examples of the financial instruments. And so, we'll talk about these a bit more, if you like, later on when we do the last hour. There's a room for lots of Q&A. But my message to you at this point is to become a little bit familiar. You might do some research on your own. If you want to email me or have a phone call with me, we can talk a little bit more detail about what might make sense for your kind of business. But these debt instruments are quite popular, and I'll give you one reason why. They're very popular because they avoid the valuation question. Valuation in an early stage company is challenging because you have no revenue, or you have 1.2 in revenue or 1.5, and it's low, it's growing, and you believe it's going to grow, but you can't, necessarily prove mathematically over 5 years of financial performance that your company is worth X dollars. If you use the standard multiples, and we'll go over those in the fourth section when we talk about valuation, there's mathematical ways to prove valuation. There's 5 or 6 of them, and they are going to prove what the valuation is. But if you're an early stage company, or you're trying to grow and pivot, or you've only been around for a year or two, you don't have enough of a track record to prove how much your company's worth. And you may have spent a lot of money, put a lot of sweat equity into it, and put all sorts of things into the company to make it valuable, including money. But the marketplace will look at your company and say, no, it's not worth that, it's worth this. And so your valuation then is kicked down the road by the debt side of things. A convertible debenture doesn't require the valuation of your company. It's dependent on a future valuation, yes, but it doesn't require you to come up with a valuation number. And why am I so fixated on valuation? Well, it's because valuation at every stage of the way is one of those, I guess, sweeteners, one of those beautiful things that an investor looks for. So if you have had, let's say, 2 or 3 rounds of capital, you want to make sure that you have priced each of those rounds correctly so that the share price appreciates and increases every round. You cannot have a down round without it hurting the valuation of your company. What's a down round? Well, it's the round over, you were selling your shares at your first raise of capital. I don't know, I'm making this up as an example, 10 cents a share. But if you have trouble raising capital and you have to sweeten the situation for a prospective investor and give them shares at 8 cents or 7 cents, oops, that's a down round. That's a problem. And so there's a whole bunch of rules of thumb, and I'll throw in one right now. One rule of thumb: never give up more than about 30% of your business in any given round of capital. Because if you do, you will have diluted yourself out of control of the business sooner than your exit. And so it's an old lesson, but many don't understand it or don't know it. I can't prove it to you mathematically, except if I had an actual case study. And I've seen these where if you give away too much in each round, you won't have enough at the end to maintain any control or to have any appreciable influence over your company. And you may be happy with that, by the way. Don't get me wrong, that's possibly something that could be good, but it's all...
Sorry, Henry. So this is not more than 30% in one round. Do you have advice on like cumulative?
Say the last part again. Advice on?
Do you have advice on like cumulative amount of shares that that you may consider giving out over multiple rounds?
Yes, and so what we could do is I'm actually going to send you both by email a set of pie charts that I have in a different file. I don't have it with me at this very moment, but it will tell you that if you have, let's say, 3 rounds of capital coming in, Harumi, let's say you have an I don't know an angel round and then an angel number 2 round and then a Series A. If you um, if you look at my little pie chart example, which I'll send you both by email, you'll find that if your sales growth, again, I don't have a mathematical formula for you today to talk,
Mhm.
but if you if you send if you give away too much in a given round of capital without having the appropriate sales to support that valuation, you will dilute yourself too quickly. And so the answer to that partly is to have the simulation capability. So I could go off on a tangent here, which I hope not to do with you, but if you have a very good financial spreadsheet analysis capability so that you can simulate different pricing for different products, different margin, different rates of growth of your revenue and your costs, and therefore valuation. You know, one method of valuation is EBITDA, so earnings before interest, taxes, depreciation, and amortization. 3 to 5 times EBITDA is a typical valuation for a manufacturing or production business. And that's one of the ones we'll talk about in the 4th hour of this workshop. But the point is that you've got there's then a mathematical simulation capability. So my little pie charts that I'm going to send you take a particular case and they show you how a certain level of sales growth has to occur so that your valuation is maintained, and therefore you can support being diluted to down to the point where, let's say you started out with 80% of the company, but you'll end up with, you know, maybe 8% of the company, but it's such a bigger pie that you're still going to make 50 to 100 times your initial investment. So Harumi, that's the it's a long answer, but I will send you the pie charts, but I'll ask you both to support that concept of those pie charts by having a very good financial forecasting ability so you can simulate things. I don't know if that helps you at this point, but that's what I would suggest on that one. Does that sound like something?
Okay, thank you.
Okay. All right. So on the equity, let's skip over to the equity side of things. And I'm thinking that in about a couple of minutes here, we might, maybe at 10:15, we might take a few minutes break just so that we can refresh the coffee or hit the restroom or whatever. But on the equity side of things, there are many financial instruments as well. There are people who will put in money on a milestone basis. So they will actually buy shares, but on a milestone basis. So they'll say, okay, you've asked for $500,000, Dale. I'm just making that up. You've asked for $500,000. I'm going to give you 50,000 now, and I'm going to see if you can meet milestone number 1 that you showed me on your slide number 8 of your 12 key question slide deck. You say you're going to do, you know, milestone number 1 in 4 months. And so I'll give you $50,000 to do that. And then once you've achieved that milestone, come back and see me and we'll talk further. So no longer do you actually get the check for the whole amount. Nobody does anymore. Although there was a time 10 years ago even where an angel investor seeking or an entrepreneur seeking $1 million would get $1 million check or $100,000 checks from people. It's in the bank. You get off, you go and start producing. Well, it doesn't happen anymore. So on the equity side, one other instrument that is usually typically used is this kind of a dole it out according to milestones basis. Another one is to buy some shares in the company, take equity, but then also add what you call warrants or uh, you know any kind of some kind of condition that gives you the capacity to buy shares in the future at an attractive price once you see the performance. So options and warrants are a way that some investors work. They'll say, okay, I'm going to Harumi buy, $100,000 worth of shares in the business, but I want options. and I want the options to buy those shares at the same price as I'm paying today. So they don't have to spend the money, but you have to commit to giving them further shares. And so you better hope that your financial performance, is there, so that when you do give them those shares, that you can actually afford to be diluted to that extent, and that the company can support the valuation. Otherwise, there's a challenge there. So on the equity side of things, there's different types uh, of ways to do this. The multiple rounds of investment is another way that equity comes in. It's okay, you want $2 million to grow into 3 world regions. Well, we're going to give you $1 million to grow into 1 world region, and then we'll see what it looks like, and then we'll help you grow into region number 2 and region number 3. It's a little bit like this milestone based thing, but it's actually discrete. It's more like, here's $1 million. Let's look at the company when you have achieved certain valuation or other targets that we mutually agree on. If I haven't said it often enough, I'll say it again. The process of becoming investment ready is that you are going to be ready to tell a powerful story to the investor, but you're going to be telling that story on a basis that they have to believe it at every step of the way. And it's a negotiation. It honestly is. It's a negotiation, because they will have expectations and they will want to propose conditions to you, and you're going to have expectations and you're going to want some conditions as well. And so it's all about negotiating. And that's why later on, when we talk about negotiating strategy, we're going to talk about how you simulate various steps of the way. So very important thing. Still on the various financial instruments, the different rounds, you've heard this conversation about angel and VC and Series A and Series B and all of that, or going public. Some companies early on will go public. There's a Canadian an exchange in Canada called the Canadian Securities Exchange, CSE. It's an alternative to the TSXV, and it usually takes technology companies. A lot of the cannabis companies are in there as well, but it takes companies at a fairly early stage and takes them public. And so equity comes in, but from the public markets rather than from private angel investors. So that's a whole other ball game, but it's another example of another kind of a financial instrument on the equity side. There's greater liquidity there, right? Because if you're on a stock market, people can buy and sell your shares every day. Whereas if you have an angel investor comes in, they will put their money in. Well, there's no market for those shares unless they can find another buyer to take their shares off their hands. If they want to get out of your company, there's a problem there. So you can see on the equity side, many different kinds of approaches. So I'm going to maybe say one more quick thing on this, and then we might take a 2 or 3 minute break and then move into the second part of the second module, the life cycle of the business. The other thing I was going to say, though, is that go back to this plus delta concept. I would urge you in everything that you do to prepare your business for investment is continually do that plus delta analysis on everything you're doing, whether it's people or decisions or directions or financial simulations. And the plus delta not only is about the qualitative things, but also on the quantitative things. So if you're working on your company and you can see that you have a mathematical simulation spreadsheet analysis that allows you to simulate good scenarios and bad scenarios, extreme ones, the so-called bookending, where you have the worst case and the best case, and then you select something in the middle. It's important to continually analyze objectively and realistically. I still see, honestly, many deals brought before us that are, I don't know, naive is the word. Don't be naive. And I know you aren't. You both are, you've done some wonderful things in business, and I admire that already. Yet we have to be careful not to look at our deal in less than objective terms. We need to always be objective. And one of the best mechanisms to test yourself is to do the plus delta and to share that with other people. If you have you know, let's say you have a sister in the business, Dale. Well, if you were to do a plus delta on your business along the way, it'd be interesting to see what her plus delta would be. Harumi, same thing. You have a team, and so when you're doing the plus delta analysis on any particular given move, to have that widespread and used by that, have that analysis used by many people would be very positive. So anyway, so I'm going to stop there on this, first of all, this first module of segment 1, and I'm going to move to segment 2. We'll take about, say, 2-3 minute break just to, and come right back. Is there anything that I can help with on this first part? Is there any question or any concern you have so far?
I just have a question about the SWOT analysis versus the plus delta.
Yes.
You mentioned that you used a plus delta quite a bit. Is there a particular reason between using the plus delta versus the SWOT?
Yes, the SWOT is more of an aggregate analysis, so it puts it all into place completely, and so it requires the reader of the SWOT or the interpreter to understand, when you're talking about strengths, which strength applies to which feature of the company. Like, is the strength in the team, or is it in the, you know, the proposed market? The plus delta is a more micro tool. It looks at let's say you take your team. You could do a plus delta on your team, and it has very little to do with the SWOT. You know what I mean? It's different than the SWOT analysis because it's about the team only, and you do this plus delta with the questions that you ask. It's a more micro tool and therefore a little bit more precise. Both are good. Nothing wrong with either of them. The SWOT is more, it's a bigger picture thing, and it gives you the bigger picture of the strengths and weaknesses and the opportunities and threats for the company at large. The plus delta takes one of those elements and then it micro analyzes it. That's the difference in my mind.
Got it. Yeah, thank you for that.
Okay. All right. Well, I'm going to I think I'll just stop my video for a second and I'll come back in about 2 or 3 minutes. Is that okay? All right.
Yeah,
back
that
in
sounds
3 minutes. Thank you.
Okay.
All right, I'm back. We'll just check if you're both back as well.
Yeah, you bet. I'm here.
Great, thank you, Dale. Harumi, if you're back, maybe you could let us know. And there we go. We started the recording again after the break. So I'm going to continue now with the second segment 2, I guess we call it, matching the business life cycle with the types of capital. And that'll take us to the top of the hour. And so, like I said, we'll have a hard stop at 11 o'clock Vancouver time. And we will then regroup. The next session will be deal structure and valuation. So those are real meat and potatoes kind of topics, and I'm looking forward to doing those with you. Another reminder that, if you want to phone me or email me between sessions, I am going to send you that pie chart thing so that you can see some qualitative examples, and you could start to build your spreadsheet simulation capability, which you'll hear me preaching about quite a bit, because that'll help you to understand the various scenarios that are in front of you. But anyway, for the balance of this session today, the life cycle of the business. And so why am I talking about that? Well, it's because the investor wants to match in his or her mind the life cycle of your business. And there's two reasons that they do that. One is they want to match the life cycle of your business with the life cycle of their investment philosophy. And that's not a scientific thing exactly, although a fund, an angel fund or a venture capital fund actually will have an expected life. They will say we're raising this money for 5 years, and in 5 years we're going to take stock of where we are and we're going to liquidate all of our investments or whatever. And so they want to make sure that if you are proposing I'm just making up a silly example now, if you're proposing a 9-year scenario and their fund or their consortia, let's say there's 5 investors that get together and pool money to spread the risk. If they're on a 5-year cycle, well, they're not going to be interested in your deal if it has a 9-year life cycle. So in its simplest way, the investor will want to know the life cycle of your business. So what should you do about that? Well, my suggestion is that you know what the life cycle of your business is. And one way to know that is, what's your exit strategy? And that's a common question. They'll say, Harumi, Dale, what's your exit strategy? And you'll say, well, in 3 years, we want to grow to this and this and this. And we want to, and we're going to be bought out by our competitors, or we're going to be bought out by so-and-so or whatever. And you lay that story out, a little switch clicks in their mind. It's not in the 12 key questions, but it's like a preliminary qualifying question. Does my life cycle of my investment match this one? My billionaire example that I spoke to you about a few minutes ago, that fellow in the last 18 months, when he was already deciding that he was going to retire, well, he didn't take on any new deals that were longer than a 1-year lending profile, because he didn't want to, mess up his schedule. So that's one reason that the life cycle of the business is an important point. The other reason is a little bit more quantitative, and that is that one feature that investors will always look for now is the lifetime value of a customer, the lifetime value of a customer. And I don't know if you do that in your business, but I would urge you once again to start thinking of your customers according to their lifetime value. So it's like the arc of the story again. How long does it take to find a customer, cultivate them, go through the entire sales cycle, and get that first purchase order? Well, it takes, weeks, months, days, whatever. In your business, it's unique. what's the lifetime value of the customer? How do you keep that customer? What are the stickiness factors? What are the things that you must do to always keep them loyal and faithful to you through great service, excellent product, whatever it is? What's the typical lifetime value of a customer? Obviously, you'll want to maximize that. You'll want to have a lot of customers with long lifetime value, and you'll want to pay more attention to them, and you'll want to pay, this will sound counterintuitive, less attention to those where you have a short lifetime, although you'll want to convert them from short lifetime to a long lifetime value. And so this notion, I won't go on too long about it, but the notion of having the calculation done on the lifetime value of a customer is very important. It's part of your story. When you talk about your revenue projections, you can say to your prospective investor, I'm very confident in my revenue projections because I know that once our customers are with us, they stay X number of months, X number of years, or X number of times of purchase. Let's say it's a recurring product. If it's a subscription model, like a SaaS model, well, how many months do they sign up for? How many conversions are there? How many drop-offs are there at the annual sign-up time? You know, if you lose, is there turnover? Do you lose half your customers every time there's a calendar flip on the commitment, the contract period, all that stuff. So I'm just saying the life cycle of the business is an important part of your story, and the matching of the investor's life cycle with that of your business is important, as is this lifetime value of the customer. Similarly, in the business itself, the life cycle of the business, if you're a rapid exit kind of company and you're going through things and you're planning to, I don't know, do it in 18 months or 24 months, one way to become investment ready is to understand in your business what happens to the typical exit. What are the exits going on? Are they, especially if it's private companies, it's maybe hard to track, but you'll need to develop some techniques for tracking the marketplace and for looking at your competitors to see what they're doing. And so you would want to know if your life cycle of your business, your own plan is, I don't know, I'm making this up again, 4 years to an exit, but the average company in your sector does it in 2 years. Well, you're not going to be as investment ready then as you might think, because what does the investor want? Well, they want it quicker. They want to do it quickly. And so that's just a simple example. If you intend to go public, well, there's a certain life cycle involved there, but it's involved with a certain process that the public market goes through, the particular stock exchange, to assess your deal and to understand whether there's enough, liquidity and whether there's enough interest in your product and so on. So you need to understand if the investor that you're looking for, it has that profile of patience, of whatever your life cycle plan is, compared to what they have in mind for their funds approach. There are some concepts. There's a guy in Vancouver. Now his name is going to escape me. Basil Peters. So you might look him up. Basil Peters. And Basil Peters wrote a book about 5 or 7 years ago called Early Exits. And the concept, he did an analysis of Canadian angel and VC exits. And he concluded that Canadian businesses hang on too long. They expect to become, I remember his famous example, it was, they all want to become the next BlackBerry. You'll remember when BlackBerry was ahead of Microsoft or Apple, at least on the consumer mobile phone market. So the point is that everybody hangs on too long in Canada, according to Basil Peters' analysis. I have not seen whether he's done one currently, but I can tell you that when he did that, it kind of was, it led to a lot of debate and discussions. We brought him into Calgary as a speaker at one of our angel investor dinners, and he gave us his presentation, and I have his book, and it's an interesting book. But the point is, it says that the life cycle expectation of the Canadian startup in that era, 10 years ago, let's say, was to hang on too long. And that led to a resistance to financing them. So can't tell you if that's true today, don't know. But your mission, it's all on your shoulders, not on mine, right? It's all on your shoulders as an entrepreneur to convince the investor that your strategy, your view of the life cycle of your business matches that of the marketplace, and certainly that of their fund and so on. So I'll just say not much more about early exits, except you should know in your own business, if you're going to seek outside capital, as we said at the beginning of this workshop, you're definitely on a path then to a rapid exit. You're on a path that's, beyond your control. You have to move at high speed and with great dispatch to exit, so that investor will be satisfied that they should invest in you because you're on a path that matches theirs. And if you are planning an early exit, you might find yourself more attractive to possible investor, which means, though, early exit has consequences, right? If you are exiting too early, well, you're going to leave money on the table. That's your fear as an entrepreneur, right? As an investor, I suppose an investor doesn't care about that as much, although they don't want to leave money on the table either. So the alignment between your expectations as entrepreneur, their expectations as investor, very important, right? And that's why I go back to my earlier statements. It's all a negotiation. Another way to put that is this life cycle thing is all about communication. If you constantly are in touch with your investors and your prospective investors to make sure that you're in alignment on this life cycle thing and on the notion of an early exit, and that you're willing to take guidance. In other words, are you coachable? It's a famous phrase among investors. It's no insult to you intended, but the investors want to see if in your quest to build a beautiful business, and to whether you want to make money, get wealthy, or get out of it after a certain number of time, whatever it is, they want to make sure they're in alignment with you on that, so that you both are in positively joined at the hip, as they say. The communication strategy that you employ to constantly talk about things, to review them with your existing investors or your prospective investors, this communication thing is a big factor in making yourself investment ready. I'll dwell on it just for another second here. There's a huge fault in the angel investment world. Investors complain most often about this communication thing. They used to say something like, when they wanted my money, they were constantly in touch with me. They gave me reports, updates. They spoke to me. They briefed me. They updated me. But when the troubles started, challenges occurred, they were gone. We didn't hear from them. They wouldn't talk to us. They wouldn't even ask our opinion, because sometimes angel investors have solutions for a crisis in a company, but the company's afraid to talk to their capital because the promises earlier made maybe are not coming, or the world has changed and the factors that they originally anticipated have been set aside and replaced by a new one, like a pandemic or something that has come in and shocked the world. So my suggestion to you, if you want to be very investment ready, is develop the habit of excellent communications, quite open book, quite candid. There really are no secrets between an angel investor or a VC and an entrepreneur, because you all have to be so closely aligned, and you need to be very clear on what your expectations are. So there are several, just dwell on the types of exits. We said that there's the obvious one where you sell to a competitor, or you sell to somebody in the marketplace who's trying to consolidate. Sometimes people sell to their employees. So it's often the case or not often, sometimes the case in software companies where somebody will sell to employees. Sometimes it's the case in product companies where you'll sell to an employee. In consulting, or there aren't that many angel investment deals in the consulting business, but there are some research or data type companies where the sale to the employees or the original, a group of the original founders takes place. And so that's a different kind of exit than an actual sale of the business. Sometimes there's a consolidation that occurs where somebody will come in and do a roll up. So an example of that would be in the fall of 2019, just before pandemic time. I had a client in Calgary who was those court reporters, whatever they call those, the court reporter people. That business was perfected. It was probably the leading one in Calgary. There's, I don't know, 7 or 8 of them in Calgary. And somebody in the US put together a fund, 500 million, and they were going on an acquisition shopping spree. And so they came to Canada. They went to Toronto first, as they usually do, and they picked off a company in Toronto. And then they came to Calgary second, and they found my client. And she was, she carefully worked with them, did the due diligence, and then she exited. So they wrote her a check, and she got a cash check, and she then found. Well, first of all, the timing was brilliant because fall of 19, she had put her check in the bank and then proceeded to watch the world change. And I don't even know what happened to that business, but court reporting has obviously changed from the in-person model that they used to use. But my point is that the consolidator did a roll-up, they call it a roll-up, came into Canada and all over the US. They bought up a bunch of these companies. Then they created efficiencies by centralizing and consolidating all the admin, all the HR, and even the technology, because apparently the court reporting business is changing. It is not going to be so much in person anymore. They anticipated this, and they were going to be doing Zoom and other, well, nobody even knew the word Zoom 2 years ago. It was really, we're going to have this online or some kind of camera ready technology. Well, how little they knew they would be in a model now where court reporting and all of that is going to be done virtually by camera or by audio only, and with automated captioning and other such technologies. Anyway, it's a long story, but that's the message about having sort of types of exit in mind. Roll-ups are a common way. So my suggestion to you is, if you're in a business that is somewhat commodity-like, where there's a lot of competitors, it's a busy, crowded space, you might want to watch for the opportunity to exit maybe earlier than you think by some industry consolidators that come through and do roll-ups once in a while. In Western Canada right now, coffee roasters, if you want to buy another business, and you're both, I know, well ensconced in your business, but the coffee roasting business is ripe for a big roll-up, because they're all small shops making from $500,000 to, let's say, 1 or 2 million in sales. It requires a level of kind of attention to detail, like a craftsman would, like a brewmaster type of thing, because roasting coffee is not easy, and you can get it wrong and your sales plummet because people have discriminating taste in coffee. I don't drink coffee myself, but I understand that people have discriminating tastes. The point is, in Western Canada today, all these guys are they're mostly men, they're in their 60s, and they have no successor. Their kids don't want it, and their family doesn't want it. And so somebody's going to take out the coffee roasting industry and consolidate it. Same with HVAC, plumbing, heating, electrical, all those little white trucks that you see running around, those vans with a typical profile in Western Canada is it's a guy now in his 60s, and at home, his partner, his wife, takes the phone calls, does the bookkeeping, does the invoicing, writes the checks, and he's out there doing the service. Well, who's going to buy that kind of business? There is not a profile of investors today, or entrepreneurs that want to work that way, that sort of lifestyle of 6 days a week, 12 hours a day, and always on call. So my story, the reason I'm telling you all this is that my message is, please always think about, once you start this investor ready thinking process, you are destined for an exit faster than you think. it is your job to help maximize the valuation of your business and the wealth that you might produce for yourselves and so on by understanding all the different types of exits and the timing thereof, not just the kinds, but the timing of the exits. So again, I don't mean to, harp too long about that, except to say that this is the art of the investment readiness, as well as the science. The science behind it is the pro forma financial spreadsheet analysis that allows you to simulate all kinds of scenarios. The art of it is judging when to exit or watching the marketplace to see. Harumi, you've got your hand up.
Yes. I'm wondering how this fits into our company, or how we fit into this whole process. So as I've mentioned to you before, we were very mission oriented, and we when we did Series A, like, we were looking for investors that are aligned with our mission. And for that reason, I think our investor universe may be somewhat limited, and we do not have any plans to go public ever unless we can maintain control. And we don't really have any exit plan either. I mean, many of the people that work with us, we're doing this for ourselves, almost for our personal missions. And it's much more than a job. So I'm wondering, with no plan for exit, how that might go with, say, Series A.
Well, it's a very good question, Harumi, because you might find that that your target audience for investors is like-minded investors who fit the same profile that you just mentioned, who are committed to the cause, who believe in this, who are kind of mission driven, we might say. And the beauty of that is later on when we talk about the kinds of investors, which will be in the fifth hour, where the profile mindset kinds of investors, there are investor groups out there that identify what their approach is, whether they are cause or mission driven. So I guess I could give you the simple answer, which is there will be investors for you. I believe that. But they will be a certain niche, they will be a certain type, and it's your job to pierce all this kind of complexity and find them. And that's a challenge. We'll talk about that in the fifth hour, but I think that's the answer to it. Now, on the other hand, there are times when people have taken a company like yours off your hands because they come in with an unbelievable offer. Now, that's not just miracle talk. That does happen. And so there might be somebody who wants to acquire a bunch of like businesses, such as, let's say, the retreat business. And while you might have a particular philosophy and approach, there might be some other types of retreat businesses that are more, I don't know, I'm making this up now, lifestyle or recreation oriented, or hobby driven or geographic tourism driven. And somebody might want to do a roll up of all of those types of industry, and they don't care so much about the mission and the cause and the belief that you have, and the common kind of sustaining belief that you might have in why this is a good business. That happens too. And then the decision becomes one of sort of, I'm not going to say it's an ethical decision, but it becomes a question then of values alignment. If you want to build up a beautiful business that has a certain belief, and you have a certain way of looking at the world, but then somebody comes along and they're going to change that and pay you a lot of money, well, it causes a bit of an ethical dilemma. So, but I'll keep in mind that we need to talk specifically about how you will find Series A people that share your cause. In a certain sense, maybe I'll say one more thing, Harumi, on your question. Sometimes it won't even matter, because the Series A will look at you and say, great, customer alignment, founder alignment, everybody believes, everybody is confident, they work together as a harmonious team because they share kind of a worldview or an approach to things. And then that will be the answer. And so if that's the case, then you'll be successful in that. Or if you don't want to exit at all, to find if you don't want to exit, to find the fund that's going to, put money into your deal. I can't say, I'm not saying it won't happen, but it will be difficult to square that with, their life cycle strategy versus yours, which is to carry on permanently. So you might have to find a different kind of investor still, that will put Series A money in, but will not be, be happy and content to stick with you for a long time. It's just a matter of finding those investors. So I don't want to oversimplify, but that's the answer. It's so we need to find a special kind of investor for you that matches and is aligned with you. Does that make sense to you?
Right. Yeah. I mean, I think because we are so selective, like we don't want to be in a position where we have to raise and find those and potentially have to take money from non-aligned investors. So we're now just focusing on trying to become profitable or at least self-sustaining on our own. And when we meet those aligned investors, then maybe we can raise, and that would be the next step.
Yeah. I'll give you another example that comes to my mind as we're speaking about this very question. Crowdsourcing, crowdfunding sometimes brings alignment of founders and, the wider investment community. Now, crowdfunding may be smaller dollar investors, I don't know, whatever, it's a different thing. But I've seen, Front Funder, for example, a Vancouver-based fund, crowdfunding group. They had I don't have the name right, but there's an Islamic group that is proposing a certain kind of a fund that invests in either Islamic-owned businesses or in an educational process that is in alignment. And so they're putting this fund together, and Front Funder, took their deal and put their mentoring work into it, and then they promulgated the deal out in the marketplace, and they raised them a bunch of money. I don't know how much, like 300,000 or 500,000 or something like that. Angel round, but what you'd call an angel round, but actually, crowdfunded. And it was a values-based business, you'd call it. So it's possible, and it's requires some extra work, but the concept still depends. The investor still wants excellent financial performance, right? They still want that. But values alignment is a big deal. And fortunately for your situation, the world is heading more in that direction. People are willing to identify what their values are and then seek capital on that same basis. Does that sound like something then? All right. So just looking at my notes here for the last, the last thing I might say then is one of my examples was hang in for the long run. And so once again, there might be a different model that you could develop, Harumi, in your business, where people might, I don't know, buy shares in the company that are part of a share structure where they can come in and out, even though the company itself might want to stay for the long period. You might develop a set of shares, like a certain class of shares, for which there could be a small marketplace where somebody comes in and they might come in for 3 years and then take dividends, let's say, and give financial performance success in their bank account, and then exit, and then sell their shares to somebody else. You might create a mechanism like that. One of the things that it will require your company to do is to probably, to attract that kind of capital, I would guess that they will be looking for regular dividends then, which means cash flow, which means not waiting until 5 to 10 years from now to exit. Let's say you never want to exit. Let's say you want to keep this thing going for 30 years or 50 years. The expectation on the part of the investor then is, okay, we'll ride with you for 30 years, but you got to give us this, 5-year window where we can exit in 5 years. Or we'll be happy to stick with you for 30 years, but you got to pay us good dividends every year. So then you'd have to set up your business then to be cash flow positive It's not the same as going public where the pressure is on you quarterly, but when you're in a privately owned business that wants to hang in for the long haul, you might want to create a semi-annual dividend structure, or an annual dividend structure that is very positively paying out cash on a regular basis, which means you'll have to set up your financing in a way that generates that cash. Especially if it's a seasonal business. Again, I'm getting too technical here, but if it's a very seasonal business, it's harder to do that. But if the business is not that seasonal, then you might be able to create a model where you can pay out a dividend on a regular basis and keep people happy that way. So we can.
Great. I mean, so at a high level, there are ways to compensate for not having an exit strategy.
That's right. Yes. And like I say, the summary comment is the world is very attuned now to values alignment. And so it's not, your request of the marketplace won't be unusual or odd. It will be a little bit more complicated, true, but because financial performance still counts, it's, it may not be as difficult as we think. And so to do a search of all of the investor groups that are seeking, values alignment with your company, it's probably not that hard to do because the information is all out there, but it'll require some labor and some time. That's the thing. So just looking at my clock here. I think that we're nearing the end of this second segment, the life cycle of the business. The point is, in summary, on the life cycle part, always be thinking about doing the life cycle analysis. Values alignment. Is your life cycle in sync, in line with that of the investor's fund or their philosophy? And then particularly important in this segment is to understand the lifetime value of a customer. If you can prove that you have great stickiness and that customers are loyal to you and that you have a product and a service that is really attractive to the customer, then you're in good shape. Alternatively, if you are a pure commodity business, I don't know, I'm making up somebody that buys something on the basis of only of price competition. It's hard then to get the lifetime value of a customer because they could be in and out depending on the price. If you're selling a commodity, you won't have necessarily a beautiful analysis to show the investor about the lifetime value of a customer. But of course, that's not the kind of a business the investor wants anyway. They don't want to be in a business that's commodity. They want to be in a special business that's unique, that brings something different and unique to the table. So anyway, that's my conclusion about the second segment here. Would we have any questions before we adjourn for today? Any questions that either of you has that we haven't answered yet?
No, I don't have any questions. I mean, that's really great, very informative, and just want to say thank you for sharing all this with me. And I look forward to the next session on I believe it's on the 24th, on Wednesday.
Yes, so on Wednesday at the same time, so 9 o'clock till 11 Vancouver time. And so thank you, thanks Dale for participating. Thanks Harumi. Look forward to that one. In the meantime, I'm going to send you those pie chart analyses, those examples. And if you have any questions or comments, don't hesitate to email me or phone me or text me, and I'll be happy to speak with you. And if I don't answer your call, it's because I'm in a meeting or something, but I will definitely get back to you quickly. And we will see you on Wednesday. We're going to talk deal structure and valuation, two very important meat and potatoes kind of topics. And I'll try to leave you a checklist in both of those areas of what you should be aware of and some practices that you would want to implement in your business to be investment ready. All right. So thank you again. It's been great to be with you guys, and I'll see you on Wednesday morning then.
Sounds great. Thank you very much, Henry.
Thank you. See you both later. Thank you. Bye-bye. Bye.
You bet. Bye-bye.